Please welcome to the stage Khurram Mian, MENA Assurance Leader at EY, Engineer Tawfik Diab, Executive Chairman and Chief Executive Officer at Cairo Capital Group, Saket Narula, the Group Chief Investment Officer at Beltone Holding, and moderating this session is journalist and presenter Nouf Katheeri.
What a morning, ladies and gentlemen. Thank you, Khulud. So, something important to discuss here. Opportunity alone does not attract capital, but confidence does. And in this session, we have a very interesting group of people. We have the auditor, the most fun group of people, as always, and we have from the structure, we have strategy and structure perspective, Engineer Tawfik, and we have also the technology and innovation perspective, Saket, and I forgot to say, Khurram. Please give a big round of applause to our speakers here. And usually we're gonna go with order, but this time we're gonna start from the middle. If you allow me to start with you, Engineer, I'm going to ask you, from an emerging markets perspective, how should investors balance local growth opportunities with global diversification to manage risk effectively?
And okay, طبعا this is an important question that everyone is trying to balance. When you come to think about the emerging markets offer a lot of opportunities and a lot of growth. However, sometimes when we think about diversification, we look at diversification from a geographical point of view. And I think we need to balance about a couple of things. You need to balance the geographical diversification and at the same time look at the revenue drivers. So the revenue drivers for your portfolio, they need also to be uncorrelated. And many examples I've seen where people feel certain comfort with industries, with specific industries or specific markets, and they actually go ahead and overinvest in these markets. Of course, home bias, whether home bias is for a specific market or home bias is for a specific industry, is fine, but it needs to be controlled. And I think this is really, as the event has mentioned, this is where discipline has to kick in, because discipline is what is going to hold off and force you to balance between having a diversified geography and as well as diversified revenue drivers that are all uncorrelated with each other.
Thank you. I like your answer when you said discipline, because as I stated in the beginning, opportunity alone does not attract capital. There are other elements to consider, and discipline is one of the biggest elements to consider. And moving to Saket, you bring today a very interesting perspective to this dialogue. We're going to talk about technology and innovation with you. And the buzzword in the past 2-3 years is what? AI. AI. So how will AI reshape capital allocation over the next 5 years?
First, thank you for having me here. I think every leader in this room is trying to make that judgment call as to where should he invest in the next few years and why should he invest. Historically, all investments, whatever scale they may be, have been based on past historical data. And AI will certainly change it. AI will bring in the tools and the right technology so people can invest in the right places. Instead of investing in about 10 projects, they will be very focused on investing in about 2 or 3 projects. Things will get very streamlined in terms of how people visualize data, visualize information, and they take it from there.
How people visualize data, I think that's the key, really.
That's great.
Because AI itself is not a destination, it's a tool. On how?
You know, a mid-sized company with AI tools will start competing with larger organizations because they will have access to more relevant information, while if a larger organization, a larger financial institute is still trying to catch up on those things.
Interesting. Thank you. And we're going to come back to you as well. And we keep the auditors for last, as usual. And Khurram, today's financial statements rely heavily on assumptions, models, and projections. From an assurance perspective, where do you most often see risk underestimated in judgment-driven balance sheets?
So thank you for having me here. I think as the capital markets have become more and more deeper and sophisticated, the accounting profession has actually followed through as well. And whereas historically the balance sheets which you used to see were all based on cost, now there is a hybrid model and a number of assets and liabilities in the balance sheets are on a fair value basis. And this is where we as auditors find the most judgmental areas, where the more higher risk areas. So examples are, you might have investments which are in equities or in derivatives which are not publicly traded. And therefore you have to do a level 2, level 3 valuation. As a result of that, you are dependent on a number of assumptions. And this is very important. And this is where the risk area is and where we focus as auditors. And to have a robust audit, it's very important to have that layer of focus on these particular areas. Another area is intangible assets. You know, the most common example is a lot of balance sheets carry goodwill, which is a most common intangible asset. That requires multiple assumptions, and that also requires forward projections. And this is an area where we as auditor, we find a lot of risk because forward projections need to be then validated, back-tested to continually justify the level of an intangible asset a company is carrying. That requires a lot of assumption, that requires a lot of business input, that requires a lot of rigor from the auditor side. And this is where we find the most risk in today's balance sheets.
Interesting, and I want you to keep that in mind because I'm going to come back to you with another question. But for the time being, I want to go back to Engineer Tawfik, who talked about discipline, and want to catch up on the role. What role do regional asset classes such as private equity, infrastructure, or real estate play in building long-term diversified portfolios in markets like Egypt and the region in general?
Well, that's an interesting question because you've chosen 3 different investment categories that should be uncorrelated with one another. And in itself, investing in these 3 areas gives you a certain diversification away from risk. When we look at private equity, we're looking at operational growth, value creation through operations. So you're looking at companies that you're managing, turning around, or even just investing just to continue the growth cycle. When you evaluate infrastructure opportunities, that's a different animal. You're looking at slightly less returns, you're looking at sustained cash flows, easier to finance, as opposed to real estate. And real estate, again, acts as, since you've mentioned Egypt, acts as a hedge against inflation. And for many years, it acted as a hedge against devaluation. As you know, we've been through a very tough time in terms of FX and liquidity. For a number of years, it's now behind us completely. But real estate helped a lot of investors hedge a little bit against this, against the devaluation process. So you need to, again, discipline has to start kicking in for you to be able to balance between the 3 of them. Look at your long-term liquidity needs and your short-term liquidity needs as well. And again, discipline and structure comes in to make sure that you force yourself to allocate between these 3 asset classes, not only in your geography, but as well across the region. And you've seen a lot of, for example, UAE investments come into Egypt, particularly in the real estate area. While the UAE has a booming real estate market itself. So this is one of the examples, I think, that are very telling about using geography to de-risk some of the portfolio returns.
Interesting. So I understand from your answers that these 3 different classes have 3 different approaches, but discipline is needed in each and every one of them.
and across all three to make sure that you properly allocate between the three of them.
Interesting. Thank you so much. And I go back to Khurram. How does modern audit move beyond compliance to become a real driver of investor confidence and capital allocation?
Thank you. I think the audit has really evolved, and I would say there are two dimensions which have made them more investor-friendly. One is technology, the other is specialists. So what I mean by technology is that, those of us who have been in the audit profession for a long time, we grew up in the traditional audit, which was always based on sampling, because we did not have access to technology. Today, we have access to technology, so we are able to look at all the transactions of our clients which we are auditing. We are able to, as a result, the pendulum has shifted from what could go wrong to what has gone wrong. And this is only possible because of modern technology. We are able to do correlations between elements of balance sheet and income statements. A simple example being sales, trade receivable, and cash. We can look at the entire population data set and see if that correlation works, and that gives us validation immediately on very important elements of the income statement and balance sheet. Before, we used to always do a traditional sampling approach, so it was not. Other areas we can use technology is we can see whether if something is there which doesn't make sense. If we see journal entries being posted on a public holiday, on a weekend when we don't expect, being posted by someone in an organization who is not expected to be posting journal entries, they're all red flags which technology allows. So technology has played a very important role, and recently we are now building AI into this as well. So AI is the next frontier for us from an audit execution perspective as well. And the second dimension which I mentioned is specialists. So traditionally the audit used to be done by financial auditors who were CPAs or CAs, but now for any large audit, up to third to almost 50% of audit is done by specialists. Who are those specialists? They are valuation specialists who help us doing enterprise valuations for goodwill impairment or intangible assets. They are real estate specialists who play a role in trying to value investment properties you are carrying at fair value, whether they are valid. They are treasury specialists who support us in doing OTC derivative valuations. So all these specialists are really bringing value. So when the audit itself is becoming more sophisticated and it's becoming more diverse in terms of the skill set which people are bringing to it. As a result, the investors, the management is getting more robust assurance from a result of the audit.
Thank you so much, Khurram. And I like the 2 points that you talked about and touched upon, one of which is technology, and that brings us back to Saket. And how can technology and real-time risk visibility help organizations stay structured and avoid short-term allocation mistakes?
To add to what Khurram just said, I think strong organizations, they really value the information that they have. So the problem, as I said earlier, is not about the data, but the visibility around that data that we have. Organizations historically were more reactive. Now they are turning up to be more proactive because of the access of information that systems are building up, the AI models are providing to them. They are handling information in a very much structured fashion that they were doing it much earlier. So my 2 cents on that.
Thank you so much. I really like the point you mentioned about visibility. So the problem is not the data itself, it's the accessibility and the visibility of it, right?
And they're more relying on a single source of truth. So, finance, operations, strategy, they all look at a single source of data than having different dashboards across the board.
Interesting. And that brings me to the last question that I want to ask all of you, which is, as markets grow more complex, what is the single discipline investors and institutions most often underestimate when allocating capital? And looking ahead, what must change in how capital is governed, deployed, to ensure sustainable returns rather than short-term resilience alone? Who wants to take it?
I'll go with that one first. I think one important criteria is that risk management today is considered more as a formality than people taking decisions based on the information that's given. So that is something which I feel needs a lot of attention. Second thing, the analytics the systems generate today, the chief investment officer or the leaders in the group, they look at those AI reports only when the reports are favorable to their thought processes. If they are not, those reports are actually ignored. I think that correction has to be done as well.
Who wants to add? Yeah.
So I think I have a very similar point from a trust dimension as an auditor in this panel. I think we see a lot of focus when capital is being deployed, a lot of rigor. But once it has been deployed, when the monitoring stage is, when we come in as an auditor looking at the balance sheet, we feel sometimes that rigor is not there. And one of the reasons it's not there is because of the governance framework of an organization is not as robust as it should be. When you also appreciate that we have a system of performance reporting which is short-term. For listed entities, it's quarterly. For everybody else, it's annual. So sometimes capital is deployed for investment which is longer term. And there is an inherent stress there. And this is why to have it's very important to have robust governance. And that does not mean only that in structure, but also in form. So the people who are involved in that governance have the right caliber, who bring the right challenge, and who have the courage to stand up. And if there is information, as Saket said, is some report which is not showing you good information, you actually see there is a consequence for that. And that consequence follow through to the balance sheet. So this is an area where we feel as an auditor, when we see the stronger organizations, they really focus on this.
Interesting. So we had the strategy, the trust perspective. Will the structure add any last points?
And I think the points were covered, I think, quite eloquently, but from a risk perspective and what we need to do, I think what I'd like to see is from a little bit of a different angle, which is the opportunity. Yeah. There's a law called Amara's Law, which is Roy Amara has said many years ago, which is that people always overestimate the impact of technology on the short term, and underestimate the impact of technology on the long term. And many people have quoted this, including Bill Gates and others. But so this is, I think, very important for us to keep in mind whenever we're looking at investments. And this ties into what was mentioned about AI so clearly. The impact, one of the things that people overlook is the impact of technology on the long term, on specific and particular industries, not the fact that they're going to be here or not, but on how they will perform under such tectonic changes that have taken place. So yeah, the risk is important, but I think another very important risk is that you might miss the opportunity. So this is also something that we need to always, again, discipline to balance between the actual risk and the risk of missing out on an important opportunity that could eventually change the performance of an entire portfolio.
Thank you, engineer. I think you ended it with a perfect note, and to remember that opportunity alone does not attract capital. And in this session, we went beyond the headlines and we dived deep from 3 different perspectives with great panelists. Thank you so much.
Thank you very much.
Thank you.